Hi, everyone. Thanks for being here. It's Jason Zilke, President and CEO of Northern Alliance Trust and Shelter Lending. Uh, Northern Alliance Trust, we started with a very simple idea. Wealth should be built on stability and not speculation. So, for over a decade, we've helped Canadians grow and protect their capital through conservative residential lending, focusing on real homes, strong, stable markets across Western Canada. Today, I'll share what makes our model so resilient, from our structure as a mutual fund trust to our underwriting process and how it all delivers consistent returns and peace of mind. At the end of the day, our goal is simple: to offer an investment you can count on so that helps you sleep well at night. Okay. Shelter lending, we are the approved manager that we have the rigorous underwriting process, over 120 years of experience in underwriting in the mortgage industry, and Northern Alliance Trust, and that is our mutual fund trust. You can see our return there, and we've been around for over 10 years now. Here's our team. Dave McKittrick, our founder and CEO, and you can see Jason Zilke, myself, the president. And we have a really strong team of underwriting, mortgage professionals, and investment specialists. Our directors, and between our directors and our staff, this is an important number. We make about 17.5% of our mortgage fund. So we are significantly invested between the directors, our families. We have a significant portion of our investment, and so we make a large part of the mortgage fund. So how it all started? Well, I don't know if you were involved in the mortgage industry in 2008, but our owner and our founder, Dave McKittrick, certainly was. And what he had was at that time was a large mortgage investment corporation portfolio. And when the crash happened in 2008, 2009, well, what happened was all these properties like commercial, raw land, construction, high loan to value products, they were in jeopardy. And it was a significant blow to the portfolio when that all happened, and it was a very, very difficult time for that. But what we realized that the residential part of that portfolio remained very resilient throughout the whole 2008, 2009 crisis and beyond. So in 2015, when we launched Northern Alliance Trust, we had a single focus: residential mortgage lending. And so we've stuck to that focus for over 10 years now, and we focus on average price point homes where demand is highest, and that's our sole priority. So we don't deviate. We don't do again commercial raw land construction development. We stay in our lane. It's very singular, very vanilla, but we love what we do. We know what we do. We do it really well. MFT versus a mix. So why did we decide to become a mutual fund trust instead of a mortgage investment corporation? Well, the major difference is, and you may have heard this, maybe you haven't, mix cannot own property and they have to foreclose on it. So they must sell it as is, whereas, regardless of the condition or the resale value. So if you ever have to foreclose on a property, one of the things that a MIC cannot do is that they cannot remediate that property, they can't fix it up, they can't own it. And we actually are able to do that. So we can actually own the property, we can fix it up, we can rent it out, or we can wait till the market changes. We can also fix it up and renovate it. So two really kind of good examples. We had a foreclosure on in Victoria, and we had to remediate some of the property. We had to paint it, we had to do some work to it, and that ended up being a really good decision because it was worth much more after doing some of those renovations, and we were able to sell it for a value and come out very, very clean. We also foreclosed on a property in Edmonton in 2021. So we actually took that property over. We've actually used that as a rental property for the last kind of 5 years. The value is significantly up when we first foreclosed on that property, and the value is actually worth more than what's owing on the property today. So it was a great decision to do that. So we still own that and rent that out. So that is some of the flexibility that we have as a mutual fund trust versus a regular MIC. You probably heard lots of MICs, but a mutual fund gives you much more flexibility down the road in the event something that may happen, and it does. The mortgage landscape. So 76% of mortgages outstanding in Canada are held by the banks. Only 24% is held by non-bank lenders. It doesn't sound like a big percentage, but it's billions of dollars that are in the residential private lending market. And so we have about 60 million of mortgages. We have about $80 million under management. We have just about $62 million in mortgages as of today. And so that's a very small piece of the overall puzzles, but we just want to highlight the landscape for the private mortgage industry is very, very large. There's lots of opportunities, tons of appetite, and it's only a growing market. And it's really growing kind of every year over year for the last 10 years or so. So we think it's a great market to be in. Lots of opportunities, tons of room to grow, and a very, very low delinquency rate in comparison to many other high risk lending, which we are not. So private lending, how does it work? Well, why would anyone want a loan from us? Well, many people have, whether it's income issues, they may be self-employed, maybe they have some credit issues, maybe they owe taxes, the timing of their house purchase. The banks, they look at personal information, and we look at the property and its value, equity, and liquidity. And that's really an important to understand the difference of how banks versus how we underwrite a file. So we're looking at the entire picture, their story, their property. There's many, many, many factors, and so all our business comes directly through the mortgage channel. So in kind of Western Canada, there's over 10,000 mortgage brokers licensed, and we work directly with them. So it's their clients. They're working with them, and they've tried to go to their bank. Their banks have said no for various reasons, and now they've kind of come to us and say, hey, can you look at this file? So everything has come directly through the mortgage channel. That's how we get all of our business. And many of those just fall through the cracks, whether they just started a new job, a new business. There's just a plethora of reasons why someone might come to us. It's not all bad things. We're just looking at in a bigger picture. Again, we focus on the property, not necessarily just the borrower and their story. So we're looking at a much broader picture. The banks have a very, very tight, rigorous criteria where we can actually look at things. So that's how we are doing our lending. So what do we look at? Well, we look at the property first. Where's the property? What is the condition? Where's the location? What is the loan to value ratio? And then finally, we're looking at the borrower. And so that's how we underwrite. That's how we've done it forever. We're going to continue to do it that way. It's a very, very rigorous process that we go through. But we look at the property. Is it average price point? Where's the location? What is the loan to value ratio? On average, we're about 62% today loan to value ratio. So 62%, meaning for every $1 million, we put out about 620,000 or 62% from the loan to the value of that property. We only use third-party registered appraisals in whatever community that we might be lending in, and that's that. And so again, you can see what we don't do. We don't do commercial, farm ag. We're not doing land, not doing construction or development or anything like that. So we're really, really focused on residential lending, and that is served us really, really well and served us our investors really well as well. So how do we have predictable future cash income, live free of market instability? How do we feel confident in our investments, and how do we put capital to work outside of the public markets? And that's really the modern investment challenge, and that's what we're here to kind of solve and help you solve. And it's really just about creating this stable fund that's it's not sexy. It's a really simple, understandable, very easy to explain. We're lending on real properties where people really live. So again, why Northern Alliance Trust? Well, we have a very rigorous selective underwriting process. This is a location. So this is what we look at. Where is the location? Is it a place that's easy to sell? If you don't pay us, we have the ultimate covenant. We have registered on title. And where is the property? Single family. Is it a condo? What kind of type of property types? We're very limited on the property types that we have, only where people live, and not things like that. So what is the type of transaction? Is it a purchase? Is it equity takeout, refinance? Those are some of the things that we're asking for. And then what is the reason that someone might be coming to us? Well, maybe they have an employment change. Maybe there's a divorce or an illness or an accident, something that happened. And then finally we look at the loan to value of the property. Again, the valuation criteria. We only use accredited third-party appraisers in whatever community we lend. We're looking at the borrower's financial strength, their credit score, their income net worth. Maybe they have other properties. Do they have other applicants like family members and things like that, or parents? And then what is the exit strategy? What do they how do they plan to pay us out? How do they go back to their bank? And we're motivated for them to go back to their bank and And basically, we don't want them paying high rates forever. We want them to go back to their bank and move up the credit continuum. And that's our part of our goal, is to help them exit. If we don't ever think there's an exit plan, but maybe we shouldn't do this type of a deal. So that's what we did. So again, we focus on the property first, not the borrower. We had $300 million worth of requests of mortgages in 2023, and we issued about 100 million of commitment letters. And of those 100 million, we only funded about 30 million. So it's less than 10% of the applications that we see. We actually go all the way to funding. So we're very rigorous in how we underwrite, and that's a really important to know. We don't do every deal. So what are some other ways we can reduce the risk? How do we reduce the risk for investors like myself? Well, we do 1-year terms in geographical geographical diversification. So for a 1-year term, well, we know the market is going to be really current, the appraisal is going to be up to date, and we are really, really diverse in kind of Western Canada, whether it's Calgary, Edmonton, Red Deer, whether we're in Winnipeg or whether we're in the Okanagan or on the island. We're really diversified through multiple markets. Our lending practices are conservatives. We don't deviate from our core business. As I said many times, we are only doing residential lending. We don't deviate from that. We never have, and we never will. It puts our investors at peace of mind, and we know exactly what we're doing. So there's a lot of opportunities out there, but we know what we do. We do it really well. And every single quarter, we set a loss provision aside in the event there is a loan that's in default, that's something that happened that goes into foreclosure. Well, we have funds set aside in the event that that could happen. And obviously, if we don't use those funds, they go back to our investors as dividends. And so we don't lend, again, on commercial properties, real estate development, construction, or raw land. So that's how we're really mitigating our risk. We are going above and beyond and taking as least amount of risk we have, because we know in a market downturn, people still need a place to live or rent. So foreclosure process, risk mitigation. So less than 10% of defaulted loans actually go all the way to foreclosure. So our delinquency ranges from kind of 1 to 3% of our entire portfolio, and I think I said we have about 62 million mortgages. That equates to about 325 loans. So of those, 1 to 3% could be in default at any time, and of those, some will go all the way to foreclosure. So don't have a lot, but no one likes foreclosure, but it happens. But our best mitigation is to follow our proven underwriting guidelines. We ultimately have the law on our side because we register on title. If they don't pay us or they default, well, we have legal action to actually take that home back from the borrowers and make it our own. We can, as I said a week before, we can either resell that, remediate that, rent it out, whatever we decide to do. So we have the law on our side to do that. So that is how we do it. So that is why we look at average price point homes where people live. So we don't want things like log cabins or unique properties, very high value properties. So we want average price point homes, which really mitigates your risk down the road. So if you ever have to sell a regular average price point home in Calgary or Kelowna or Edmonton, something like that, it's much easier to sell than something that's 5 times, it's a $5 million home or something like that in Edmonton. That's going to be a very difficult property to sell, likely not sell for the top value, whether it's but maybe it's a single family home that's worth $450 in Calgary. Well, it's very average price point, very easy to sell and remarket because it's not unique and it's very cookie cutter. So that's kind of the ultimate strategy what we have when it comes to foreclosure and a risk management process. Liquidity. Well, all our mortgages are 1-year terms. So renewals are offered annually to borrowers. Most borrowers do renew, and they pay out the following year. So it's around 18 months that we see on our average is what most people are kind of are with us, even though we do 1-year terms. So approximately 40 loans in our portfolio are paid out annually. So our book is constantly churning. So we're always putting new mortgages. So it's just under half our portfolio turns over every single year. That is a massive amount of turnover. So we know our appraisals, our process is up to date. We check in annually at the 1-year mark, and if they're not in good standing, well, we don't renew with them. But if they are, then we can certainly offer renewal to them. So our book is constantly turning over and churning. So why Northernlights? A couple of statistics. Well, today we have 315 mortgages with a weighted loan to value of about 62.5%. So that's a really low loan to value. So again, for every $1 million, that means it's about 620,000 in actually mortgages or loan amount. So it's a really safe, healthy number. Where we are. So here's our mix of portfolio. So about 52% of our portfolio is in British Columbia, in major centers, about 43% in Alberta, and about 5% is in Manitoba, which is basically Winnipeg, greater area. Our property types. So you can see the bulk of our portfolio is single family homes. And so we know that there's a very massive shortage of single family homes. There always will be. We believe those are going to be the highest value for forever just because they're not building as many. We have about just under 10% of townhomes or row homes, a few service lots, a couple of duplexes, and then about 6% of condos. So we don't do a lot of condos because we think they are a higher they're more volatile, and there's a potentially could be an oversupply. So we really limit on the condos. We think duplexes and townhomes are much closer to a single family than a condo. So we just don't do a lot of condos. You can see the mix that we have there. So why Northern Alliance Trust? Well, higher returns. We've returned up to 8 to 9.5% annual return. Those dividends are paid quarterly. Again, your investment is secured against tangible assets that don't move. You know that it's not like a car or something like that. These homes, they don't move. They are fixed assets, and they are going to be there until they're no longer there. So yes, mortgages. Most people have had a mortgage, so it's pretty easy to understand what a mortgage is, how it's registered, and that's how we do our lending. We have a proven track record, so we have a consistent dividend return since 2016. We have an annual return of over 8% for a decade, about 8.24% for 10 years annualized. We have two investment options. We have A units and B units. Everything is secured against real property. Again, no raw land. And the owners are investors. As I said, we make about 17.5% of our mortgage fund is made up from our directors and owners and our staff and their family. So we are definitely invested to make this healthy and effective. You know that we're heavily invested in the fund. So just here's a great example of the compound effect of, let's say, 9%, 100,000. So you can see, look what happens at the 25 years. When you're 25 years old, you put in 100,000. At 35, at 45, at 55. You can see what happens to your money over time, the compounding effect, and a steady, consistent return, which we've had for the last 10 years and we will continue to have. It's just really kind of strikes to the consistency of a compounding interest and how it continues to grow and grow and grow. As I said, we have two units, A units and B units. The A units, they get paid first. Their returns capped at 6%, 6.41 annualized. They basically get paid. All the dividends get paid to the A unit holders first, and then the remainder gets held over to the B units. So you can see kind of our 5-year, 3-year, and 1-year returns in our A and B units. Obviously, the A units are the same. B units, there's no cap for any B units, so they potentially could have inherently more risk because the dividends are paid second, but for 10 years the B unit has paid a more of a dividend for this. So you can see 8.39 for the last 5 years, 8.68 for the last 3, and 9.14 for the last 12 months, 1-year period. So that is the difference between our A and B units. You can ask us any questions you have there. So why Northern Alliance Trust? Well, it's never a bad time to invest with the trust. Capital preservation and stability always work, and outside factors marginally affect our fund. We have a really strong capital preservation strategy. We avoid likely future instability in the public markets. Well, again, there's almost next to no volatility. In 10 years, our very worst quarter was 7.5%, and our very best was 9.5%. So it's a really stable market fund. And again, historically strong, predictable returns. We are 100% Canadian owned, operated, and where we lend. How the investment fund works. So we raise money, we take invest capital. It runs through Parvis, which is our third-party exempt market dealer who do the qualification, the regulatory framework, and those funds get invested into Northern Alliance Trust, our mortgage fund. Shelter lending, the manager, we manage those funds, we lend them out on real property, and we return the dividends to our investors. Again, 6 to 9.5% to depending on if you want A or B units. So you can see the consistent See, investment that will let you sleep at night. So you can look through our last 10 years and see there's next to no volatility. Volatility between 7.5% and 9%. Our very worst year, first quarter was 7.5%. The very best is 9.5%. So we really know we are going to return something that is in between that band for the next 10 years. And, it's a really consistent strategy that will really help you if you don't want any volatility like the public markets. And you can see investment that may keep you up at night. The market, you just can't predict its stability or instability. So we believe that our product is safe, secure, and very, very effective to hedge against the public markets. So you can see as of October 1st, 2025, we have about $80 million in assets under management. We have approximately 300 investors today. And you can see the kind of the growth of our fund. In 2016, we started with a small investment of $500,000 to start our fund. And today we are over $80 million. You can see the growth, the trust that our investors have done, and we've done a great job managing this fund for a decade now, and so we know that we're going to continue to do that and do it really well. So that's you can see the growth of our fund and where it's gone from and where it is today. Well, questions. Thanks so much for joining us today. We're happy to take any questions you have. You can reach out to us anytime. We are happy to go over the fund, answer any questions, and of course, we'd love to have you invest with us. And we look forward to working with you and your investors, and happy to take any type of registered or non-registered funds through personally or through your corporations. Thanks so much.